Welcome to NREI's Common Area Podcast. This podcast is brought to you by the award-winning editorial staff at nreionline.com. Let's jump right into this week's podcast.
Hello and welcome to the Common Area with your host, David Bodamer. Today we're going to have a special guest on, and that is Charles Krawitz. He is the Vice President and Head of Commercial Lending at Alliant Credit Union. Good afternoon, gentlemen. How are you?
I'm doing well.
I am fantastic. Thank you for having me.
Absolutely. So how are you holding up overall, given what's going on? Where exactly are you based?
We are based in Rolling Meadows and in Chicago.
And is everything, just weathering the storm there?
So we were, it's very interesting. We have, call it roughly 625-ish employees, and we were fortunate that within a day or two of the work at home, we were down to about, call it 20 people in our two offices combined. And so we are operating very, very efficiently as a credit union in service of our members, of our depositors.
One of the things I was curious just to start with is I don't often talk to credit unions in the who are working in the commercial real estate space. So if you could just take a minute to talk about the organization and the ways that you do financing for the space and how that's maybe a little different than some of the other lender types that people are working with.
Sure. Yeah. You don't typically find credit unions to be go-to sources of commercial real estate financing. And there certainly are some that are active in the space. Most are active in the smaller range, I'd say in the $1 to $5 million range, and they are typically confined to a very, very limited geography. Alliant is a little bit different in that we have a national field of membership, and we are a down the middle of the fairway commercial real estate lender that is out there offering loans with constructs that are similar to what you would find from regional banks, similar to what you would find in the CMBS space and in the in the insurance company space as well. We're national lender. Our average deal size this past year was about $11.5 million.
Okay.
And we lend to commercial real estate investors who are well-heeled, who understand the asset type. It's their business. It's not a one-off investment. It's not a hobby. This is, our borrowers do this for a living. And we're fortunate to be one of the largest credit unions in the country with a little bit over $12 billion in assets.
Okay. And in terms of the loans that you're doing, are you doing just senior debt, or you do any bridge financing? What kind of products?
So about 85% of our loans are on stabilized properties. 15% are more bridge in nature, but I would call it light bridge. It's where we are on the 20-yard line, or deals on the 20-yard line, and we can kind of see how that gets into the end zone.
So you're dealing in a fairly safe part of the market.
Yes, by and large, yes. So there are some transactions where we have participated with other lenders. We are not a construction lender, so we have participated with other lenders on construction loans, lenders that have specialized in that space, and we've been able to play a role in the capital stack with those lenders.
So given all that, what are you seeing right now? Just given this unprecedented kind of pause in the market, are there deals that are still happening? Are you doing financing right now? Are people buying, selling? What's going on out there?
So we are certainly very active on the financing side. We have not pulled back. Certainly the terms that we offer have changed significantly, much more conservative in nature. I don't think there's as much purchase activity as there was. The transactions that we have seen really since the pandemic has taken hold are refinance opportunities, transactions that several weeks ago we may have been looking at and offering a cash out and limited to no recourse. In today's world, that cash out is being very structured. It's something that will allow, but it's something that will allow after 18 months of performance, proven performance from the point of making the loan forward. It's not a day one proposition. And oftentimes the loans that we're structuring now involve some degree of recourse, and that recourse again being structured so that it can burn off based on the performance of the underlying asset. And then I would add to that, oftentimes we are looking for some kind of debt service coverage reserve, and that it varies by property types. And we do lend, generally speaking, on all property types.
Okay, so it sounds like deals are still happening. Some of the pricing and maybe some of the conditions and debt service coverage ratios and those kind of things are adjusting and I imagine maybe even changing on a week-to-week basis at this point, but it's not as if there's nothing happening.
That's correct. And we're fortunate where we're a fairly nimble organization and able to be very, very responsive and structure deals on a one-off basis. There isn't, a one-size-fits-all proposition. We've never been a program-oriented lender. We've always been willing to understand the stories and the drivers that underlie that real estate opportunity.
So in these weeks, we've seen the Fed introduce a bunch of programs or reintroduce programs in some cases like TALF, and we've got Congress doing the CARES package and now talking about other packages. I think the big question that I think we are, there's a lot of awareness that obviously that this has happened. I think the question that we are asking, and also we have people asking us, is how much have these moves helped, and do you think that there's more that needs to be done from the, either on a legislative level or on the monetary policy or Fed facility level to help the market right now?
I think the government has really stepped in and stepped up, and it's been very, very helpful. The liquidity that they have pumped into the marketplace has been very, very helpful. Is there more that can be done? I think that is definitely the case. In particular, you look at a couple of property types. You look at hospitality and you look at retail. And those are property types that are going to have a lot of difficulty rebounding and are in need of perhaps more tailored and direct assistance than the market at large.
So that
maybe that takes the form of low interest rate loans, super low interest rate loans that are specific to hospitality and retail, as a means of helping these properties recover over a much, much longer period of time.
Yeah, so I think that gets to a related question here, which is, so right now, we're seeing these deep impacts and, the hotel occupancy numbers are out there, the retail sales numbers are out there. So there are these massive hits that are happening. So that we know that eventually, and I think there's some expectation that maybe in the time being, depending on the strength of the operator or the borrower on these assets, there might be a period where they can continue to cover their loan, or they may be able to work out some kind of arrangements with their lenders for extensions, but that eventually there's going to be distress opportunities that are going to emerge. Do you have any expectations for how we might see the distress cycle play out once we're kind of out of this immediate crisis period?
That is a great question. A lot of uncertainty, obviously, around that. Properties in general were, prior to the pandemic, we're starting to move away from single-use, traditional use in nature. So multifamily was having to incorporate, some kind of Airbnb concept into their buildings, and they were having to look at what they had intended to be retail space and using that as perhaps co-working space. And so property owners, I think, have been challenged recently to be more dynamic, to not be so staid and thinking that their property, could only be used in one particular fashion, and offering more of a dynamic mix. And when you look at hospitality and you look at retail, the challenges that those properties were facing prior to the pandemic only get kind of magnified in a post-pandemic world. And so anyone who would want to acquire those properties, distressed or otherwise, would need to be a visionary, would need to be creative in how they were going to position those assets on a go-forward basis. Because it's hard to envision that a lot of the retail properties are simply just going to continue to exist as storefronts. We were facing the need for the experiential component of it, and that is heightened even more. So the challenge of that will manifest itself even after the pandemic, even after perhaps a cycle where properties are distressed and they come onto the market at a low price per pound basis. It's, what do you do with it from there?
Yeah. Okay. That's a really interesting point. No one's kind of mentioned that before. So that's very interesting, but I think that's really right. Like this idea that, so it's not just necessarily you take a building that has a certain level of vacancy and then you just work really hard to release it. You have to think about maybe these outlooks and even the some of the modified behaviors that we might have coming out of this that may persist even after the crisis, to think about how you're going to re-tenant or really get that space to work.
Yeah. What does an entirely different tomorrow look like?
Yeah.
Based on the internet, based on the fear of high density living, based on new shopping patterns.
Right. I mean, have you found, I'm sure your own behaviors around working and consumption change during this that you see persisting once we are allowed to back out again?
No, I mean, I think personally, I'll go back to my old behaviors, albeit, with some hesitancy to get on a metal tube in the sky. I'm not going to be rushing out. I think obviously Zoom and others have shown that there's ways to have, I guess, call it intimate contact through the computer screen.
In terms of, doing business right now, sorry, like looping back, it just occurred to me another question, like in actually, in terms of like actually closing, deals, is all that stuff just now happening with like DocuSign or, exchanging secure documents online and getting those things done that way and doing stuff through Zoom?
So not fully. I am admittedly going into the office a couple of evenings during the week to make sure that I don't run into anyone in the elevators, and I am physically signing documents. Will it eventually be the case that these documents can be signed electronically? Yes, unquestionably.
But it's not. But it hasn't been something that you have had to immediately like flip a switch on.
No, there was some talk as to how to do a video notarization, and I think we have those mechanics down. If and when the transaction pops up that requires that, but we have not done it yet.
In terms of like the distress, again, like thinking about this distress cycle after after the financial crisis, Great Recession, I feel like that distress cycle lasted for almost like for several years of opportunities, and part of it was, I think, the way that if I'm remembering it correctly, and you can correct me if I'm misremembering it, but the way that I remember playing out was that part of the way the distress cycle was managed was to kind of delay some stuff from coming through the system, so that like it wouldn't be overwhelmed all at once, and that banks could work through a certain amount of bad, distressed assets or REO at a time, and then in some situations like offer, did these extend and pretend and amend situations to try to delay and prolong this process. And then it felt like that actually that actually worked to an extent, because we did get through all of that distress, obviously, and reemerge into a strong market. So I guess
I think right. I think last time the slow bleed really was a result of the lack of capital cushions by financial institutions. Mm-hmm. And since then, the regulatory environment has changed that, and financial institutions are much better capitalized, and accounting laws or regulatory requirements are such that losses get recognized immediately.
Okay.
And so I don't think you're going to have the pretending. I do think you're going to have a lot of extending. Mm-hmm. One, recognition of the fact that there's not a lot of capital in the marketplace. So if a loan's, maturing, where can you reasonably expect a borrower to go? And two, the Great Recession showed that we were better off trying to work with borrowers and to have solutions play out over time, and not to kind of rush things along. That wasn't a win-win for anyone. And I think in the negotiations that I enter into with borrowers that are feeling the pinch right now is one really aimed at trying to figure out how can we both win. Now, what is a meeting in the middle between my needs, which are keeping funds flowing to the credit union's members, to our depositors, mm-hmm. and the borrower clearly suffering from a lack of cash flow at the property. And oftentimes we've been able to find a confluence of interest by being open and honest with each other, and that will mean some longer workout scenarios, unquestionably.
All right, well, I think those are the kind of the questions I had. Are there any other, observations or things happening in the market that you think would be important to for people to know about that we haven't discussed?
Well, I think it's important for borrowers to recognize that there isn't a one size fits all, and so they're inclined to hear something on the news that maybe it's because a lender has the backing of the government, or maybe it's because a lender has a different capitalization structure, has the ability to access the public markets, and because of that, they're able to and willing to offer up some concessionary packages. That doesn't mean that every lender is necessarily coming at the situation from the same backdrop, and that there should be an appreciation of that by borrowers when they try to engage, with their lenders.
Well, yeah, that seems like an important point for people to realize, because I think it is very easy to look at the news or see certain examples and then just expect it to be as simple, but a lot of stuff is going to be case by case, and it's going to depend on borrower quality and institutional standards, right?
Yeah, and I also think it's very important for borrowers to come with a game plan and to be, to think outside of the box, to be visionaries a little bit as to what does a post-pandemic world look like, and how can they best start positioning their property for that. Should they be converting a floor of their multifamily property into self-storage? Things that they've never really thought about before. I think everyone needs to think about, going forward, particularly, again, going back to retail and hospitality. What does a near-term post-pandemic world look like, and what does a longer-term post-pandemic world look like, and start envisioning that and talking to their lender about how we move from here to there, and the justification for it.
Oh, that's definitely a lot for people to chew on.
Yeah.
Well, I want to, but I think you're right too, because I started to think about it. I mean, I'm in New York City, so we're right in the middle of, the hardest hit part of the country, and I'm just trying to imagine what it's going to be like. Or, we're on pause, as Governor Cuomo likes to say, for another month, but then when we do start to open the valve and go back, what kind of density are people going to be comfortable with, and what kind of behaviors are we going to have as we start to move back into a dense environment.
Yeah, I mean, the notion that the same old will produce something other than the same old, we need to move beyond that.
All right. Well, I want to thank you. Thank you so much for, walking me through all this and discussing this stuff. I think it's been very useful and illuminative for the audience. And I appreciate you taking the time.
Perfect. Well, thank you very much. I appreciate the opportunity to share some of my thoughts, no matter how divergent they may be. Thank you.
All right, Charles, thank you so much for being on the show. David, thank you for bringing him on the show. And lastly, to the audience, I want to thank you for listening to the Common Area Podcast with David Bodamer. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when David comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your colleagues. Again, thanks for listening today. For everyone at NREI, this is Eric Johnson inviting you back in 2 weeks for all the stories that matter to you. We'll talk to you soon.
Thank you for listening to the Common Area Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of NREI or Informa. The content has been made available for information and educational purposes only.